Hi, everyone. We're just going to wait a couple minutes for people to join before we officially get started with the webinar. As we're waiting, though, why don't you guys all go ahead and comment where you are joining from today? We would love to hear about that. A few from Texas, snowless Utah.
Um,
Got LA. Yeah, I'm in LA as well. So we're not going to talk about the weather here because I don't think East Coast people would appreciate that.
mm.
Okay, I think we're good to go ahead and get started. Hi, everyone, and thank you so much for joining us for the Introduction to Qualified Small Business Stock webinar, where we will be covering generally what QSBS is and how you can qualify for it. Before we officially get started, though, just a couple of things that I wanted to quickly go over. Number one is that I know that you guys all know how to use Zoom by now, but there is a Q&A and chat feature which will allow you to participate, ask any kind of questions. We're going to have a Q&A session at the end, the final 10 minutes of the webinar, where Brian and Tommy will respond. If for whatever reason we don't get to respond to your question, Brian and Tommy will be reaching out afterwards to ensure that all your questions have been answered. So please do engage and participate. And then the other thing is also that you are eligible for receiving one CPE credit out of this webinar. In order to get that, you will need to stay for 50 minutes and also respond to 3 out of the 5 polling questions that are going to pop up on your screen. If for whatever reason you have any issues and the polling question is not popping up or you're not able to submit your answer, please do email your name, date, and also the response that you wanted to select for the given polling question to elevate.learn@armanino.com, and we'll ensure that you'll receive the credit. So with that, I'll hand it over to Tommy, who's going to discuss the learning objectives.
Hi, everyone. So we're not going to try and make everyone an expert today in qualified small business stock or QSBS, but what we want to do is help you become more literate with it. So you can identify what sort of businesses could qualify for QSBS, what the holding periods are, how valuations come into play, how do M&A transactions affect QSBS, things like that. And for our agenda, I always like to start off with a little history lesson. So we'll give a quick legislative history of QSBS. I may also refer to this as Section 1202. That's the Internal Revenue Code section that governs this. And we'll go over the shareholder benefits, company requirements, partnership conversion, that includes LLCs, M&A transactions, valuations, and then we have a couple of real world examples for you all. And to give myself an introduction, so I'm a director at Armanino. I lead the qualified small business practice, among other things. I'm also in what's called the compensation and benefits group. I do a lot of nerdy tax accounting, both for US GAAP and advisory. And I should also mention we did get a number of questions from the invite that we'll go through, and we're going to be covering secondary sales. I'm very familiar with those and how those have an effect on QSBS. And Brian, you want to go ahead and give yourself an intro?
Sure. Thanks, Tommy. My name is Brian McClellan. I'm a senior director at Armanino. I am in the Bellevue, Pacific Northwest office, and I've been in the Seattle area as a valuation provider for the last 28 years. I've seen lots of valuation opportunities and done quite a bit with tax in estate, 409A. We've done work for QSBS and tax restructurings. We also do a lot on the financial reporting side as well. So well-versed in the valuation field, and happy to be part of this presentation today.
Awesome. Thank you, Brian. All right, so now we're going to get into the legislative history and shareholder benefits. And there are, let's call them, three main pivot points in the history of QSBS. So initially, this was passed in 1993 to stimulate investment in high-risk early-stage enterprises. And the intent was to get more cash into high-risk businesses. And then the next big change, and back then the exclusion percentage was only 50%. So people can only exclude if somebody had a $10 million gain, only 5 million of that would be excluded. There was a minor change in 2009 where that was bumped up to 75%. And then the real big change happened in September 2010 when amended Section 1202 that somebody could exclude up to 100% of their eligible gain, and we'll define what that is. And then, of course, what we'll refer to as OB3, or the One Big Beautiful Bill Act, modified the holding periods, the exclusion, and a few other things. So like I mentioned before, this is passed in 1993, and the reason why a lot of people didn't hear about this for a while, another thing about Section 1202 is there's this weird concept with certain areas of the tax code where they do what we call sunset at the end of every year. And Congress actually needed to extend this every year. And back in those days, the capital gain rate wasn't as different as it was a little different than it is now. So the savings weren't as spectacular. So not a lot of people paid attention to it. You maybe saved a few percentage points due to these sub bullets in the first bullet. So the unexcluded gain, right? So let's say you have a $10 million gain, 5 million of that is excluded. The other 5 million is taxed at 28%. And 7% of that excluded gain is what we call an alternative minimum tax preference item. And we'll have some math on this on the next slide. And, the shares needed to be held for more than 5 years, and the shares needed to be issued prior to the company reaching $50 million in what's called aggregate gross assets. For the accountants and finance people on the call, it's generally close to what your book assets are, unless there's a manufacturing business that we're talking about, because there may be greater differences in depreciation for book and tax than with standard, SaaS companies that we see in the Bay Area. And that'll take us to our first polling question. So how familiar are you with QSBS and its potential tax benefits? All right, so it looks like we're at about 88% participation. So it seems like a lot of people are so we have somewhat familiar and not familiar are about dead even. We have 82. Okay. So we'll share the results. So it seems like people either somewhat or not familiar at all. We have a few people who are very familiar and a few people who are unsure. All right, so for those of you who are not familiar at all, we hope you will be at the end of our webinar here. All right, so next we'll get into what the math looks like on that, right? So, and I call this ancient QSBS. I still run into this. So I do these types of analyses for companies and write memos and things like that. And there's still a benefit, right? So at the 50% exclusion rate, the maximum effective tax rate on the whole $10 million. So tax people like to talk about effective tax rates, right? So currently 20% is the top capital gains rate. Then there's something called the net investment income tax, NIIT, that's another 3.8% on that, right? So those 50% exclusion shares, if you go and pay someone like me to do an analysis and all the shares qualify and you have a $10 million exclusion, the effective tax rate is about 16.88%, assuming that's worst case scenario. So it's still a savings of $692,000 because that's a 6.92% rate differential between the 23.8. And as long as I've been doing this, which is pretty long, I still haven't had anyone who had shares issued between February of 2009 and September 27th of 2010. But the effective tax rate there drops down to 9.42%. So it's a savings of about 14.38%, $1.438 million on the wholesale. And then again, for shares issued after the September 28th, 2010, 100% gain exclusion. There's no AMT preference item. That's one of the big benefits. So on July 4th of this year, the president signed the One Big Beautiful Bill Act, which modified Section 1202. And in something new that was introduced, and there's some other history on this. This was tried back when Biden was still in office. They wanted to change some things and not others. Like they wanted to make S corps eligible. We'll get into trust stacking at the end. They wanted to eliminate trust stacking. That's what the Democrats wanted. And the Republicans wanted to put in this tiered exclusion for people who held shares for less than 5 years. And what we got in this bill was this new concept of a tiered exclusion where if you hold your shares for more than 3 years and less than 4, there's a 50% exclusion. Now, the other benefit here is there's no alternative minimum tax, what we call an add back or a preference item for the excluded gain. And if you hold your shares for greater than 4, but less than 5 years, you get a 75% exclusion. And we have the effective rates on the next slide. Another important thing here is because none of this was indexed for inflation, right? Like $10 million in 1993 is not the same value as 2025, right? So the exclusion is now the greater of $15 million, and now we'll introduce the 10 times basis. So whatever the greater of that is somebody's exclusion. So for most founders and early employees, they're going to get the $15 million exclusion. Once in a while, you'll have a founder on their second or third company that's already had an exit, and maybe they put in $2 million of their own cash, right? Then the 10x basis would work for them. And the basis is generally the amount of cash you paid for the shares. We're going to get into how that's not always the case when we talk about conversions. And the gross assets test now, so that now the shares need to be issued before the company reaches $75 million in assets. And both of these, both the exclusion limitation and the gross assets test, is now going to be indexed for inflation. So every year this is going to change. Actually starting in 2027. So they're not changing it for 26, but 1/1/27 will start having different values here. And I will get to the question on the what happens if you went over 50 million, but never 75 in a few slides. And something else that's important to note here is, let's say your limitation is $15 million, right? You're a founder, you put in $300 with your buddy when you started the company. So you don't have much basis. So your exclusion limitation is going to be $15 million. Let's say you have a secondary sale after you've held the shares for 3.5 years and you sell $2 million worth of stock. Well, how much is your limitation reduced by? And the answer is the amount that's actually excluded. So even though you sold 2 million, your exclusion is now only 14 million instead of 13 million. because you're paying tax on the other, and it's not getting excluded due to the holding period. And here's another chart. So in that example, if I sold $2 million in a secondary sale and I held the shares for 3.5 years, the effective tax rate on the whole sale is 15.9, which is better than 23.8, and 7.95 if I held them for more than 4 but less than 5 years. And I think it's important to note here, I'll throw this in, I forgot to put this in my notes. Not all states conform. A lot of who I call the usual suspects do not, except for New York. So California does not conform. New York currently does. New Jersey did, but is in the process. They're trying to what we call decouple from this. That's where basically a lot of these states' tax codes say we match everything in the federal tax code except for these. And I think New Jersey is in the process of taking this out. I know Washington, D.C. recently did just pass something to not be in it, but I think total of the states that have tax, 12 states do not follow QSBS. So even though there is an exclusion here at the federal level, there could still also be taxes at the state level. And then for one of the questions that came in, which state matters, state where you live? It's where, okay, so that is, it'll be where you sold them. So the state in which the sale occurs. So this is, I know I've heard people saying that they're planning to leave California to Nevada or Texas, a year or two before they sell their business, some founders, right? So they can not have to pay the California tax on that. There's a whole cottage industry around that. We call it breaking state residency. California and New York are ruthless. So definitely if that's on your radar, engage an attorney who's familiar with how to do that. But something else I wanted to touch on here is somebody asked about addressing the holding periods for gifted or transferred QSBS. So that's section 1202H, and it says in the case of gift, death, or when a partnership, so remember your investors, when they distribute these shares out to their partners, which they do sometimes, so the stock is treated as acquired in the same manner. We're going to get to this shortly, what we call the original issuance test. So we want to make sure the original issuance test is met when the shares are issued, and the basis and holding period tack onto that stock. We'll talk about stacking later, but that's when somebody sets up a trust, because this is a per taxpayer benefit. And certain types of trusts, when you create them, they turn into their own taxpayer. All right, so now we'll get into the company level requirements, and I'll address another one of the questions here. How and when do founders or startups need to qualify, and is there any action required now if a transaction may not happen for 5 to 10 years? Yes. So high level, there's 12 major tests in section 1202. These are really the key ones. There's ones like, I think I do address this at the bottom, right? So in the old days, we used to refer to these as this section of the tax code as subchapter C. So that's when you hear a C corporation, that's what they mean. So it needs to be a C corporation, meaning the company files a form 1120. So this can be, so a limited liability company is a state entity type, and it can be treated many different ways. So it can be the default is a partnership if you don't make an election and there's more than one member. It can also be treated as a C corporation, or it can be treated as an S corporation. And we actually had a question come in on this that, what if a company is an S corporation now? So there's what we call a multi-step F reorganization that the S corporation can go through and turn into a C corporation. But the caveat is their holding period would not begin until the date that the company is actually a C corporation. It's complicated, too complicated to talk about on this call. And the other thing is the fair market value of the company. Well, we're going to take a deep dive on this actually later. It has to be less than $75 million on the conversion date. Now, previously it needed to be 50. So if a company converted in before July 4th of this year, the fair market value of the whole enterprise needed to be less than 50. So other bullet points here. We'll touch on this in some of the real world examples too. So when Congress came out with this, I think that this was, I guess, major internet usage, right? So they didn't want people who had just issued shares that wouldn't qualify, yes, a valuation is required to determine the fair market value. All right, but when Congress didn't want people who just issued shares, let's say in 1992, to say like, oh, we could just buy them back and reissue them. So they came out with these redemption rules. So if companies repurchase more than a certain amount of their own stock, it could cause all of the shares issued 1 year prior to that redemption and 1 year after that redemption to not qualify. And we have an example of this later in the slide deck. Something else that's important for those of you that are holding options, and this is in the committee minutes, it's not in the code itself, but convertible instruments, so options and convertible notes don't count until conversion. I'm of the school of thought that that goes for safe instruments as well. There's other people that disagree with me, and until the IRS, provides any sort of guidance on this, I guess it's still a gray area. So when the IRS does scrutinize QSBS, which they do occasionally, this isn't a heavily audited thing, but when somebody is getting audited, it's like anything in tax. There's a small community. We all talk to one another. They're generally looking at, is this company in what's called a qualified trader business? And what that means is when Congress wrote this, they excluded who I call again the usual suspects. There's something else with partnership. This benefit called Section 199 Cap A, and they excluded certain types of businesses, mainly white collar services businesses, and they're explicitly called out in Section 1202 as well. So accounting, medicine, actuarial sciences, consulting, and then the catch-all, any trade or business where the principal asset is the skill or reputation of one or more employees. And so 80% of the company's assets need to be in a qualified trader business. So sometimes we'll get, like I was just talking to someone the other day, they have a software product, right? But they also do consulting around it. But the revenue they get from the consulting is de minimis. So we think the company's otherwise going to qualify because substantially all of their assets are being used on the software side. So it's not a deal breaker. That's why, people come to guys like me to hash those things out. Some of the other rules is only a de minimis amount of stock can be used. Think of like a cash management, setup for a later stage enterprise. Usually we recommend people put money in treasuries. We don't want you going out and buying stock, things like that. Okay, and if you own your own building, you can't rent out much of it. There's a 10% rule in there. So those are the general company requirements for the company to qualify when the shares are issued. And that'll get us to polling question number 2. So what best describes your company's current stage? We got 73 out of 86. Almost there. So it looks like growth stage and mature private. I failed to share the poll. Cyrus, I don't know if you want to try sharing it, but it looks like a mix. So public are preparing for IPO. That's good. We have a real life example for that at the end. All right, next we're going to talk about, and this is where valuations come into play, where partnership conversions and mergers and acquisition transactions. So partnerships take many forms. They can be limited partnerships or LPs. I think in our world, we usually see them as LLCs, treated as partnerships for federal tax purposes. And the key here is, one, generally your holding period for QSBS purposes doesn't apply until after the conversion. There's some other schools of thought on that we won't get into. And like I mentioned before, the fair market value of the assets Now, let's say all this conversion talk will be post OB3. So the fair market value of the assets need to be less than $75 million on the conversion date. And like I said, that's the whole enterprise value, just not the hard assets. And the key here, so this is what I was talking about earlier about basis, is for purposes of determining your QSBS exclusion, as a partner, your basis for that is your portion of whatever the fair market value of the assets are. And we have an example of that later on. So, but high level figure 50-50 partners, they go convert, and the valuation person comes back and says, hey, it's worth $10 million. So in that case, each of those partners can exclude up to $50 million in gain down the road when they sell. And there's also, this is out of my wheelhouse. This is when I bring in my partnership experts, but there's other things to think about that. There's these concepts called suspended losses, built-in gain, and then whether or not the company, if it's already profitable, wants to pay that dual level of taxation. Because remember, C corporations pay tax at the entity level, partnerships don't. They pass those through to their partners. All right, so mergers and acquisitions, I'm going through two of these right now, and they're both, the theme this year in M&A was there's a lot of stock for stock and also stock and some cash transaction. In Section 1202 addresses this specifically, and it's pretty simple. So if the buyer is also a qualified small business, which was like the first transaction, it was two earlier stage startups kind of merging together, worked in the same space, and there was a lot of synergy, and they thought they would help each other grow faster if they combined. So it's like nothing happened, right? All of their issuance dates tack on their basis if they have any, and their holding period all tack on. So now they just got to make sure that new business maintains that status until there's an exit or a sale. Now I have another one where this is one of these AI startups where they've been around for 18 months. Some public companies coming in and giving them a whole bunch of cash plus stock. And, think about that. They've only held their shares for 18 months. The founders, so to benefit from this, they get to their holding period tax on and their basis. But since they're getting acquired by a public company, which is not a qualified small business, because remember, their assets are way over $75 million, the gain is capped to what it would have been if there was a sale on that date. We have another example of that later on in the slide. And that takes us to polling question number 3. Has your company obtained a formal valuation? So as a comp and benefits person, if you're issuing options, I hope A is answered for everybody. All right, looks like we're getting close to 90% participation. So a lot of people, yes, are getting them done for 409A or other compliance. A couple of people for fundraising or M&A. Handful of people no, and no, not sure if we need one. So if you're issuing non-qualified stock options, you need one. That has nothing to do with QSBS. That's just regular old tax law. All right, so while this is wrapping up, so we kind of went over the high-level aspects of Section 1202, and now we're going to get into the valuation considerations of, what the interplays are with QSBS. All right, so there are the results. Now I'm going to hand it over to Brian.
Thanks, Tommy.
This thing. Yes.
Yeah, thank you very much. So valuation considerations, especially upon conversions, are important to consider in this process, and obtaining a valuation is critical to that, taking that step and making or solidifying the QSBS eligibility test, and we'll jump into that. But I wanted to introduce the concept of fair market value. Many of you are familiar with this already, but the definition of fair market value, which is the price at which property would change hands between a willing buyer and a willing seller, neither being under compulsion to buy or sell, and both having reasonable knowledge of the relevant facts. That definition is important for a lot of reasons, right? The price or the value that you're assigning needs to not reflect any kind of valuation that would, or any type of transaction that would have been forced or liquidated or anything like that. And so it is important that we follow that definition. In addition to that, the reasonable knowledge of relevant facts suggests that a buyer would do some level of information gathering, diligence, or something looking at the company. And so it does reflect that a buyer would have some understanding of the relevant facts of the company. Those things are key because I think the appraisal report, which you would obtain at the end of evaluation, should present or demonstrate that valuation that you've received does demonstrate that that's not a forced or liquidation value, and that's based on all the facts that were obtained and reviewed as part of the valuation. So I think that the valuation report should do that. I will add too that if some of you are familiar with tax reporting, there's a concept out there called adequate disclosures that generally applies to gift and estate tax, not here. But those disclosures are really meant to help the appraisal to present the relevant facts of the valuation and the assignment. And so while it's not required for QSBS, we recommend and we think that it's best practice that those types of adequate disclosures are met when presenting or performing the valuation. And then if you're not familiar with the valuation approaches that we consider, generally there's an income-based analysis, and an asset or cost-based analysis. An income-based analysis will generally look at the future projected cash flows of the business that a buyer would expect to achieve. Those future cash flows would be discounted at a risk-adjusted rate to ultimately determine the fair market value of the company. Another approach, which is the market approach, looks at company multiples, similar to how you might look at pricing buying a house, right? You're looking at comps in the neighborhood. This is very similar activity where you're looking at public companies in the same or similar space. So we'd be looking at public company multiples. We would be looking at guideline transactions where other similar transactions have occurred, and we would be measuring or calculating those multiples and then apply it to the subject company. The last one is an asset or cost-based approach. This generally applies to more asset-intensive businesses and/or businesses with no or minimal revenue. Those are fairly early stage companies might employ that valuation method. I think too, when you think of these valuation methodology, there'll be a series of information gathering and management interviews as we embark upon a valuation process. But the analyst, the valuation specialist, should be very careful about assumptions around growth and profitability, even capital spend, because many of these companies might have a very different profile compared to other industry participants or even more mature companies. So looking at projected growth, looking at profitability, looking at capital spend and returns, those are all really important areas to consider, especially when you're evaluating perhaps the aggressiveness or conservatism that is in the analysis, and that would play into the discount rate that's ultimately used and reflected in the approach. Discounts for lack of control, lack of marketability. This is an important thing to distinguish. Many of you, if you're familiar with these types of discounts, they do apply to ownership interests in companies. However, if you're talking about a conversion from an LLC to a C Corp, which Tommy touched on earlier, you're basically exchanging the assets of the business for equity in a new C Corp. And that asset value is the value of the assets, not the underlying equity. And so therefore you would not see discounts, generally would not see discounts for lack of control or lack of marketability at that date or at that point in time. You may see it, you may come across it later if you're ever in a position where the QSBS stock is part of a gift or an estate tax transfer. So that's another thing to think about. And I think we're on to our next polling question.
Yep. So do you believe your company currently qualifies for QSBS treatment? It looks like we got a mix. Possibly, we're not certain. We've had, call it 15 or 16 have already confirmed it. About 20 said they don't qualify, and 20 are unsure. Guess we'll leave that up for another 10 seconds and then go on to the next slide. And those are the results.
Right. Well, these next few slides, I did want to talk about how certain indications of company value might exist prior to a conversion. And this first slide touches on 409A or other type of equity compensation. And it sounded like many of the participants are familiar with this concept, so don't need to touch on it too long. I guess what I would say is we have to be somewhat careful comparing the results of a 409A analysis to the asset value of a company conversion. And I think that that's where there could be some elements to make sure you're being careful. 409A analyses often will consider discounts for lack of control and lack of marketability as part of their arriving at their conclusions. And so I think it's important to make sure that you understand that there could be some differences between a 409A valuation and a company value or the aggregate asset value at conversion.
Right, and I'll chime in a little bit here. So when I go in and do these analyses, I request all of the 409A valuations, but it's because there's other data points I need in there. It's not necessary. I'm not looking at the equity value.
Yep. Great point, Tommy. Similarly here on funding rounds, if your company has received funding, either pre-money or post-money indications of value, those are interesting to look at, but also noteworthy that they may not necessarily equate to the asset value of the company. Remember, what we're talking about here upon conversion is the gross assets of the company, not an equity interest, which is generally what fundraising is going to account for. Likewise, I think you'll see in a lot of cases for fundraising that if you're going off company valuation based on the last round of funding, that analysis is very high level and doesn't necessarily take into account liquidation preferences and other factors that distinguish one share class from another. And so it is important to know that while it is something to look at and take note of, just regular funding round valuations don't necessarily indicate the fair market value of the assets either. And lastly, on secondary transactions, and you're seeing this quite often, more attention being given to secondary transactions, especially in financial reporting spaces. but these are shares issuance, but maybe you've had transactions prior to a conversion. Those might still be something to reconcile to, but again, eligibility depends on gross assets, not stock price and secondary trades. So still something to take note of, still something to evaluate, still something to take into consideration, and would necessarily be part of an appraisal report. We would definitely disclose those things, but it still doesn't equate to asset value in a valuation, fair market value for conversion.
Okay. All right, and that'll get us, and we're going to touch on secondary sales again, but that gets us to polling question number 5. So when do you anticipate needing a QSBS review or valuation? Not sure, no plans yet. And I'll touch on this while that's going on. So when I go in, we have companies come to us and say, "Hey, we read this news article and want to check in on it." And, you know, generally when we do these, I do them at a funding round when a rep is being asked in the SPA, when the company's at or near the aggregate gross assets threshold, and most importantly, right before the exit. And sometimes I've done multiple valuations. There was a question that came up on that earlier. So all right, everyone's answered. Share result. And it just depends, right? Like the shareholders, the peculiar thing with this is this is going to wind up on somebody's personal income tax return. And they're going to need some bits of information from the company in order to get comfortable taking that position. All right, so now we're going to get into the real world examples. So secondary sales, I've at this point in my career been in several hundred, of these, advised on them. Right. So we talked about redemptions earlier, and we call this the exchange transaction. So, a founder and a few early employees sell their common stock to an investor who's already on the cap table. Right. They're selling the common, and then the company turns around and exchanges the common stock for whatever, an equivalent value, not necessarily the same number of shares, but an equivalent value of whatever the latest round of preferred stock is. All right, so that asks the question, did the company just redeem that common stock, and should we run the test on it? So when I do these, I've taken a really deep dive into this at different, cases that are analogous. It's not necessarily related to QSBS. And the argument, again, that it was a redemption is there's something called the step transaction doctrine. And based on articles I've read, it's saying that it's introducing a step without a purpose, which isn't permitted under the step transaction doctrine. But nonetheless, there's still some risk there if this goes. But from a QSBS perspective, the seller, should all the other requirements be met, can take that position on the return that their sale qualifies for QSBS. And again, there's some risk. If the sale price was in excess of the 409A valuation, that the IRS could come back and say that was actually a disguised bonus. So that risk is always present in any of these secondary transactions, whether there's an exchange or not. But one of the good things about redemptions, there are some things that are exempted. So when shares are repurchased from an employee who got the shares pursuant to Section 83. So a lot of you guys have probably heard of an 83B election. There's a whole bunch of other things in there. That governs property transferred in connection with the performance of services is the technical term. So basically anything employee stock related, whether it's a restricted stock award, it's a stock option you exercise. So if somebody early exercises a stock option and the company repurchases it, the unvested shares incident to their termination, it's ignored for purposes of the redemption test. And same thing for the divorce. But something that's not clear is this second example here, right? So two founders form a company, 50-50 split. And for whatever reason, there was no vesting requirement. Say they're bootstrap founders, right? If they get into a fight a few years down the road and the company repurchases the shares from the founder who's leaving, even though let's say it's a bona fide termination too, but were those shares transferred in connection with the performance of services? There's no guidance on this. I would say, yes, they were, but there's other people that would argue and say, no, they weren't. So just something to think about. And I know I've said we don't have a lot of guidance on this. There's a concept called private letter rulings, and we can no longer get those with certain subsections in 1202. And that usually means that the IRS is preparing guidance. And we actually heard last week, I saw that the IRS has put this on their roadmap. So we don't know if we're going to get revenue procedures, revenue rulings, or actual, regulations, but hopefully we get more guidance from this soon. 2 more slides. So partnership conversion, I think I talked about this example earlier. So we talked about the basis for purposes of determining somebody's exclusion limitation. And it's, based on the fair market value of the assets transferred. And that's what Brian was explaining on the earlier slides. And of course, this example assumes, seeing the other limit is $15 million, that this happened after July 4th of this year. So this is one I run into occasionally. Yes, your company can IPO and you can still sell shares and get QSBS exclusion. In high level, what I want the takeaway for you all to be here is it's your responsibility at the end of the day to have the documentation of when these shares were acquired, how much you paid for them, because sometimes, so we ran into this, right? So what if you exercised an option right away, early exercise when you started, and then you exercise an option a few years later after the company exceeded $75 million in aggregate gross assets. So you have some shares that qualify, some shares that don't. Once these shares go to the transfer agent, they just go into your account, and they do not keep records of what, that cap table that you all use, it goes away. So you want to make sure you keep detailed records of which shares or how many shares you have that do qualify versus those that don't. And it gets kind of tricky because a lot of times around an IPO, there's either a split or a reverse split. So you'll have different numbers of shares than what you already purchased. Key thing to take home there, keep detailed records, because the broker is not required to, because they are not covered securities. All right, I went 1 minute over. I try to always end at 50 minutes, but so we got 9 minutes for Q&A. I'm going to stop sharing my screen, and I think there was a number that came in through the chat that I didn't have a chance to get to. That was the valuation required to determine fair market value. So there was another question that came in the free set of questions that I got. So a valuation is really only required for QSBS purposes if a partnership is converting to a C corporation. Because if you figure if there's a sale down the road, and like, let's say that example I gave, right? A company is getting acquired by another company that's not a qualified small business. There's something called a waterfall that they put together, and that determines what the fair market value of the common shares are, because there's usually some sort of exchange ratio that they come up with. And so that's going to be the fair market value, right? The arm's length transaction, the math, going through all the different liquidation preferences of the preferred that are sitting on top. So that's why you wouldn't necessarily need a fair market value on an acquisition date.
Tommy, we had seen a question earlier about getting a valuation at the later afterward, but I think the clarification there is that evaluation is only required at conversion, when you convert from an LLC to a C corp, and then you're maintaining that QSBS eligibility throughout your holding period. There isn't a need after that to have another valuation later.
Correct. And sometimes Brian's done a number of these for me, where the company said we converted like 3 years ago and we didn't have one done. We can go back and do a retroactive valuation. It's common practice. So for the question that came in about the Delaware flip from an Irish entity into a Delaware C Corp, those are delicate. Make sure you have competent tax counsel involved. If you want to reach out to me after, I work with probably what I would call the top 3 attorneys in the country on this stuff. Those are delicate. I've done 2 Australian versions of those this year. They're delicate. But yeah, the holding period would start when the shares in the US corporation are issued. Sure, I'll expand on the $50 million versus $75 million threshold. So For shares issued prior to July 3rd, on or before July 3rd of this year, the company cannot have crossed $50 million in aggregate gross assets at any time. And once the company exceeds that, it's still fine. You don't have to have an exit before the company hits that threshold. It's just the shares issued prior to that can qualify. And I think I forgot to mention this. So let's say, I'll just give a real world example. So let's say in March of this year, you exceeded $50 million, excuse me, but you've never exceeded $75 million in assets. All of the shares issued on or after July 4th of this year can continue to qualify. There's just going to be that stub period between March and July 3rd, where if anyone exercised an option during that period because they didn't have any other fundraising rounds during that period, those wouldn't qualify, but all the shares issued after July 4th could again qualify. And there's also touch on this. So there's something called a predecessor. Within those rules, they say, or any predecessor thereof. So let's say you're a partnership and you exceed $75 million in assets. And I've had this happen like a month ago. And then for whatever reason, they went all the way back down. And even if they converted from that partnership into a C corporation, the fair market value of their assets would be less than 75 million because of that predecessor entity that they couldn't qualify because they already exceeded it. You know, it's weird. So in the committee minutes, they said that it has to be, and those are just the notes when Congress is debating these and negotiating the terms. They specifically said any predecessor corporation there, but in the actual statute in the code, what got passed, it says any predecessor entity. So that, you know, that's my take on it is even though it's a partnership that it exceeded $75 million in the past, it wouldn't qualify.
Hey, Tommy, there's a good question from Nick there, if you see it.
Yes. Okay. Yes. I can't believe I forgot this is important. So the company needs to maintain QSBS eligibility, notwithstanding the aggregate gross assets threshold, because you can cross that. And while nothing you issued before that, you still need to meet the rest of the tests for substantially all of your holding period. So generally what that is, you know, the working capital test, if there's what I've termed excess working capital, it's just a math equation we do. It's rare for companies to exceed it, but even if they do, like back in like 21, early 22, companies were raising like $1 gazillion, right? And there were certain periods, you know, where they exceeded the limit, not the assets, but just the working capital test for maybe 5-6 months and then went back below. You know, if they have a sale, if they hold those shares for, call it 5, 6, 7 years, and they only exceeded it for a few months, you know, we think the company would still qualify, or that shareholder would still qualify. And so like Cyrus mentioned, if you know, when you're driving home today, have a question that didn't come up during the presentation, feel free to shoot it to me or Brian or both of us. Yeah.
We'll cover that. Otherwise, like Andrea mentioned earlier, we will be sending out both the slide deck and the recording in an email. You can expect to see that early next week. But yeah, if you have any additional questions, please do reach out. Otherwise, thanks for joining us.
Thanks all.
Yep. Thank you all.